Hi, good morning, everyone. Sorry for the delay. Sorry for starting the webinar late. We are starting the webinar now. Okay, this is Richard speaking. This is our usual disclaimer. Please read it. So today I'll be presenting on Capital DC REIT, which we initiated coverage on last Friday. Okay, so we initiated coverage last week with an accumulate rating, a target price 113, last post was $1.02.5. The 52-week range for Capital DC REIT was 96 cents to $1.10, and it has a market cap of about 905 million. So let's go into some preliminary things first. What is a data center? So according to their prospectus, they have defined a data center as a facility designed to house mission critical networking and computer equipment. So these photos here, you can see what it looks like inside a data center. It's just storing computers, and the last picture is just a picture of what a data center looks like. It's a building with four walls and a roof. So these are some of the key technical features, unique features of a data center compared to other types of buildings. Firstly, there's the provision of power supply here, and the space to store the computers, which is here. Next is the cooling equipment. Then they have the fire suppression systems to put out any fire quickly. The data center needs to be secure, so there's a physical security, and they have raised flooring here for all their mechanical, electrical piping and systems to run under the floor. Some facts and figures about a data center. So for mechanical and electrical installation, these components usually take up about 50 to 75% of total cost uh, of a data center. These things are the uh, cooling system and the fire suppression system. Net technical space. For data center, you may see two different terms. They call it net technical space or net lettable area. So for net technical space, this is about 40% to 80% of GFA. Net technical space is actually the effective amount of space available to put the computers. So you can see that for net technical space, it ranges between 40 to 80% of the GFA. Why it is so low, 40%, and is in the total GFA for a data center, quite a substantial amount of space, floor area space is allocated for all the other subsystems, which I described in the previous slide here. Uh, Cooling equipment, power supply, fire suppression systems. So these are some of the things which take up quite a bit of space within the GFA of a data center. Other thing is there's a shell and core fully fitted and co-location. These are the type of leases available for data centers. So shell and core basically is four walls and a roof. The REIT will own the shell and core, and then they lease this shell and core to a master tenant who will install their own subsystems. So subsystem, so the REIT only owns the land and the shell and core. Every of the subsystem inside belongs to their master tenant, who could be on a double net or triple net lease. For fully fitted, this is the REIT will own the shell and core, plus the REIT will install all the subsystems, and this will be leased out under a master lease, either double net or triple net lease. Co-location is similar to fully fitted, except co-location is to multi-tenants. So for the data center, industry, the term for multi-tenanted is co-location, and this comes from um, the origin is several tenants co-locating in the same data center. CapEx commitments. So for data center, the REIT is usually only um, responsible for refresh CapEx for their own facility. So in Shell and Core, they will not do any CapEx refresh on the subsystems like the cooling and the power supply. They will only be responsible for CapEx for fully fitted and co-location. One thing to note about CapEx as well is that um, the REIT is not responsible to upgrade computers when they're obsolete, because the computers also belong to the tenant, and the tenant is responsible for upgrading their computers when they are obsolete. In terms of electricity cost, the tenants are billed directly for electricity. So our investment thesis for data center is the explosive growth in data requirements, and there are four factors to support this. First is a growth in data creation and data storage needs, growth in cloud computing, e-commerce and online shopping, increasing compliance and regulatory requirements on data security, and finally continued trend of outsourcing of data centers. So the first is a growth in creation and data storage needs. So uh, when Capital DC was going to IPO, they engaged a broad group to do a independent market research on the data sector industry. You can read this. You can read their report at the appendix of the IPO prospectus. So for broad group, they have estimated that data created globally will grow at a CAGR of 48% from 2013 to 2018. Uh, Internet protocol traffic estimated to grow at 21% CAGR from 2013 to 2018. And to note specifically, Asia Pacific and Western Europe, which is where Capital DC's their mandate to invest in properties, Asia Pacific is 21% and Western Europe is 18% CAGR for the next 5 years from 2013 to 2018. Likewise, we find data from Cisco Systems. That's their Cisco Global Cloud Index. So they're also saying that global data center traffic will grow at a CAGR of 25% from 2014 to 2019. Their virtual networking index says they are forecasting that uh, global IP traffic will grow at a CAGR of 23% between 2014 to 2019, and in particular Asia Pacific 21%, Western Europe also 21%. Okay, our second factor to support the investment thesis is the growth in cloud computing, e-commerce, and online shopping. These activities um, will be underpinned by the growth in the number of internet users. So historically, internet users has grown at a 12% CAGR over the last 10 years. Cisco GCI, they are also forecasting personal cloud storage and consumer cloud storage traffic to grow at 12% CAGR and 23% CAGR for the next 5 years from 2014 to 20 from 2015 to 2019. The VNI Virtual Networking Index, they're saying that forecasting for consumer IP traffic, Asia Pacific will grow 22% and Western Europe 20%. Okay, the third factor, increasing compliance and regulatory requirements on data security. Firstly, there's opposing requirements because data needs to be secure, yet at the same time it needs to be accessible and retrievable. So this creates conflicting requirements. Increasing regulatory pressure on widening scope of data to retain and retention tenure. What this means is that regulators are asking organizations to retain a wider range of data and for a longer period. So this also will add on to their need for storage. And with these factors, they will lead to a demand for professionally managed data centers. The table at the bottom shows some of the regulations that have been come in place by some regulators in Singapore and in the US. Some examples. So moving on to the fourth point is a continued trend of outsourcing of data centers. So the broad group research report also forecast that the proportion of outsourced data center space is estimated to increase. So for Asia Pacific, it will increase from 12% in 2013 to 38.5% in 2018, and for Western Europe, increased from 21% in 2013 to 42% in 2018. Demand for professionally managed data centers will be driven by these 4 points: cost effectiveness, increased complexity, users focusing on their core competencies, and changing needs. So for cost effectiveness, it's actually quite expensive to um, design and build your own data center, and for smaller organizations, it's actually more cost effective to co-locate. In terms of increased complexity, it's actually getting more and more complicated to operate and manage a data center, and you need specialized staff in order to run the data center. So for users who are not in the data center industry, uh, there's incentive to outsource this so that they can focus on their core competency, as they do not have the in-house expertise to manage a data center. And for changing needs, using a third-party data center allows more flexibility as the user's needs and requirements changes, and the third-party data center operator will be able to better um, offer customized solutions for the end user. So now we go into some detail on Capital DC REIT itself. So it was the first data center REIT listed in Asia and on the Singapore Exchange. It was listed on the 12th of December 2014, and the offering price was 93 cents. So the investment strategy is to invest in a portfolio of properties which are used for data centers, and this investment strategy will be adhered to for at least 3 years unless there's a change through an EGM. So this is a trust structure. There are actually four main players within the structure. So first is the trustee over here. Trustee is the trust company Asia Limited. So they hold the properties in the trust. Capital T&T is the sponsor. The REIT manager is so Capital T&T is the sponsor, and it owns about 30% of the REIT. Um, the REIT manager is also 100% owned by the sponsor. REIT manager is Capital DC REIT Management Private Limited. And the last key player is the facility managers. So the facility managers are Capital T&T and some of the third-party facility managers. The manager's fee is AUM based, so base fee is 0.5% per annum of properties under management, performance fee 3.5% of NPI, and they will also charge the usual acquisition and the investment fee. Distribution is made on a half-yearly basis. and we are giving 100% payout until December 2016. Thereafter, they will pay out a minimum of 90%. For their portfolio, so it's geographically diversified with 9 data center properties across 7 cities. In Asia Pacific, they have 2 in Singapore, uh, 1 in Malaysia, 2 in Sydney, 1 in Brisbane. For Europe, they are located in London, Dublin, and Amsterdam. In terms of rental income diversification, their tenants come from various trade sectors such as IT services, internet enterprise, telecom, financial services, and corporate. For their rental diversification in terms of lease type, they have co-location, fully fitted, and shell and core. This is an overview of their portfolio. You can see the 9 properties here. These are the 2 from Singapore, this one Malaysia, Sydney. These 2 are the Sydney properties, Brisbane property, London, Amsterdam, and Dublin. So here you can see co-location. These 2 Singapore properties are under co-location, and so they have 20 and 4 tenants respectively. Those where you see 1, these are the master lease type. So it's this one tenant is fully fitted, 1 here is shell and core, fully fitted, fully fitted, fully fitted. For this Gold Hill data center, they have 2 buildings. So 1 building is a master lease under shell and core, and the other building is under co-location with 2 end users. So you see 3 tenants at this property here. Organic growth. So organic growth for the REIT comes from inbuilt rental escalations. All their leases have an average fixed rental escalation of between 2 to 4% per annum, and certain properties have potential for AEI as well, which is Citadel, T25, and Basis Bay data center. In terms of inorganic growth, they have done some third-party acquisitions. The first was IC2, which was completed last year in the 3rd quarter. IC2, if you go back here, IC2 here is in Sydney, Australia. They have also entered into a forward purchase agreement for a data center outside of Frankfurt. The data center is Main Cubes Data Center, and it hasn't been built yet. That's why it's a forward purchase agreement, and the expected completion is in 2018. They also have the ROFR pipeline from the sponsor. Currently, within their sponsors' portfolio is T27, Elma DC2, and T20. They also have a ROFR from ISIC Communications. So if ISIC builds this proposed data center next to ISIC, which is in their portfolio, Capital BC will have the ROFR for this data center as well. For T27, the REIT manager is saying that they're expecting to acquire it in the first half of 2016. Capital DC REIT is exposed to 4 different foreign currencies, which is Australian dollar, ringgit, pound, and the euro. So these charts show the exchange rate against the Singapore dollar over the last 4 years. And for the last 3 years as a trend, you can see that the Singapore dollar has been appreciating relative to 3 of these 4 currencies. The only currency that the Singapore dollar is not appreciating against is the pound. So the investment merits for Capital DC REIT is its unique asset class of data centers with strong underlying growth drivers. Earlier in the presentation, I've shown you investment thesis and the factors that support his thesis. The business of data centers has high barriers to entry, and the industry enjoys high degree of customer retention. It's a fragmented market with few main players and several small players. There's also a favorable supply and demand dynamics, and the REIT has both organic and inorganic growth opportunities. There's a stable and predictable income stream of 8.9 years WALE and an attractive dividend yield of about 6.7%. So now we go into some of the risk involved in investing in PPDC. Firstly, will be the advancement in storage technology. So if there's an improvement in storage technology whereby more electronic storage space will require less physical space, then this will impact the demand for data center space. Regulatory risks would be things like lease of land by governments for building of data centers and unit holder dilution and value destruction if the manager does not make accretive investments. So this table shows some of the common risk factors that most investors are interested to know about and how it's being mitigated by the REIT. So firstly is the interest rate risk. Currently, all their long-term loans are on fixed rate already. Refinancing risk, they have 9% of their total debt going to they have 9% of their total debt which needs to be refinanced this year, and after they refinance that, the next refinancing will be in 2018. At the moment, their weighted average debt tenure is 3.4 years, and they have a debt headroom of about 100 million based on a 40% gearing. Their gearing is actually currently low at 30.1%, and the management has repeatedly committed their long-term target of keeping gearing at 30%. So once in a while, it will go above 30, and then they will do equity fundraising to bring the gearing back down. For those who are interested to know about the sensitivity of the distribution relative to change in interest rates, the interest cover ratio is now 6.6 times. So this will give you an idea of the margin of safety for their EBIT divided by their interest expense. Foreign exchange risk, so they are exposed to four foreign currencies, and they have natural hedging of loans which are denoted in the same currency as overseas properties. They also carry out 2-year hedging, so using forward contracts, and so 100% of their forecasted foreign source distributions have already been hedged up to the first half of 2017. And this was as of 3Q 2015. So by now, they probably have also hedged all the way up to the end of 2017 as well. Occupancy risk, so the portfolio is diversified between co-location, fully fitted, and shell and core, and the current portfolio occupancy is at 95%. For data center, you do not want 100% occupancy. Actually, you need to have some spare space left behind so that you can accommodate your existing tenants who want to expand and who need more space. For tenant concentration risk, their tenants, as I showed earlier, they come from various trade sectors, and the IT services is the largest sector, accounting for almost 40% of their rental income. Operating risk, they have a long portfolio of 8.9 years, and 23% of rental incomes are for renewal this year. This comes from their co-location properties. So for um, our valuation, we have come to we derive a target price of 113 from a dividend discount model. The risk to our valuation, so acquisition of T27 would be highly PPU dilutive. What we've done is, so the REIT manager has hinted that the acquisition of T27 will happen first half of this year. We have made some assumptions that they will do a 30-70 um, capital structure for the acquisition, $215 million property, and with an 8% yield. So based on these assumptions, we find that there will be marginal yield accretion to the portfolio. We further assume that they will do a 70% EFR through placement with a placement price of 98 cents, which is a 3% discount to previous closing price. Um, this means that they will need to issue 100 and almost 179 million new units, which is a 20% increase over the existing 883 million units. So, based on these rough assumptions, it appears that the acquisition will be yield accretive to the portfolio, but not DPU accretive to unit holders. Having said that, I still highlight that these are just our assumptions and not so. This component is just based on assumptions and nothing is firm yet. We've done a peer comparison. Uh, this list shows all the Singapore listed industrial REITs, but we find out that Capital DC does not have any comparable S-REIT peers because of its unique portfolio of properties exclusively of data centers. So what we've done is we've gone to compare with the global peers, which are data center REITs. So there are those that are in the US, which are on top here, and the one here in Australia, listed on the Australian Stock Exchange called Asia Pacific Data Center. So if you look at their valuation based on price to book, you'll notice that um, the US listed data center REITs have got a very high price to book compared to Capital DC REIT. The reason for this is that actually the US listed peers classify their data centers as PPE on their balance sheet and are depreciated annually. Whereas for Capital DC REIT, the data centers are classified as investment properties and they are revalued annually. There's a difference in accounting treatment for their data centers, and so price to book, you cannot compare the price to book between the US REITs and the Capital DC because there's distortion in the denominator for the NAV. Uh, the closest comparative, the most comparable is Asia Pacific Data Center, which is listed on the Australian Stock Exchange. The ticker is AJD. So they also revalue their investment properties annually. But we are not benchmarking Capital DC against AJD because it's only one stock and it does not constitute as a sector comparison. Okay, so to conclude, we're initiating coverage on Capital DC REIT, accumulate rating, target price 113, last close as of Friday was $1.02.5. Okay, we've come to the end of the presentation and we'll wait for questions to come. There's a question on what is the REITs NTA. The REITs book value now is about 87 cents. There's a question on CapEx. So firstly, what is the specific equipment that's provided for fully fitted sites? So as I said, the difference between fully fitted and shell and core is shell and core is four walls and a roof. Fully fitted, everything, every specific equipment is everything. Cooling tower, uh, emergency power supply backup, power supply, um, anything that's stuck to the building is provided in the fully fitted site. Lifespan of the equipment is typically between 10 to 15 years. You can read this for yourself inside the appendix of the prospectus as well. For their capex commitment, um, this is also inside the prospectus. You can read it for yourself. They have $4 million of commitment for the next 2 years. That means 2015 and 20 over 2015 and 2016. Um, is a 4 million committed capex. Now there's a question on how will the rate hikes negatively impact the current stock price and target price. Firstly, for as I said earlier, all their long-term debt has already been hedged, so it's fixed rate. So regardless of how the rate hike goes, they are still going to pay the same amount on that, except for if they refinance the new debt. There's a question about whether DPU is sustainable moving forward. It says that a previous dividend given out has a one-time component effect due to some forex savings. Uh, can you elaborate? Where do you see this? Okay, this. Sorry, I didn't complete the answer for the capex commitment as well. So there was a add-on question about will it result in lumpy payout when major upgrades are required to replace equipment reaching the end of useful life. Okay, so currently the REIT they're giving out 100% payout uh, up to the end of 2016. So the thing is that if they require to retain some money for capex, then they can lower their payout ratio. And so yes, there will be some impact on the um, distribution. But having said that, you have to take note that every other um, property also requires capex, and every other kind of property also requires capex. Whether you have a retail REIT where you're doing AEI, it also costs money. You have an industrial REIT where you have a change in tenant and they have to reconfigure the space, it also requires money. It's part and parcel of being a landlord. Sorry, we don't comment on other house reports. Hi, there's a question compared to Keppel REIT and the data center REIT about their dividend. The thing is that one is an office REIT and the other is data center REIT. So it's not a fair comparison that way because the risk is different. So um, it's it's not it's not comparable to say that one is paying better dividends so far. There's a further question on the refinancing. Uh, okay, so for target price, it will not be affected, um, assuming that there are two more interest rate hikes in 2016, because the existing debt has already been fixed at a fixed rate already. The target price will change if there's new debt taken on during 2016. Okay, to add on for the question on DPU sustainability and one-off forex gains. So if you look at our set of forecasted statement, actually um, the GRI is actually quite flat. We're actually taking into account some depreciation in their foreign exposures already. So I think it's quite conservative. And in terms of one-time component, yes, it probably could be one time, and then they may have to report certain uh, realized losses for their hedging as well. Having said that, this is part and parcel of having a geographically diversified exposure. In the long run, having a diversified currency exposure um, is supposed to even out the fluctuations as well. There's a question on how does Capital DC differentiate its data center from the competitors. So one of the difference in their model in which they operate is that their focus is only on wholesale and wholesale co-location. So they are not doing retail co-location and managed services. So that's one of their differentiating um, factor for um, their differentiating factor, and also this helps them to do their so-called sale and leaseback um, acquisition as well. Okay, these are the last question, I think. So it says the question is it prudent to buy this counter when it is trading above NAV while many REITs are trading below NAV? So the first thing I'll point out is that for this data center REIT, if you compare all the other REITs listed on with all the other S REITs, this is a unique portfolio of data centers. So it's not comparable with all the other S REITs, um, with all the other S REITs. And for the in general, there's a supply demand imbalance um, for the subsectors. Whereas for the data center REIT, if you go and look at the third-party report by Broad Group, it's showing that net absorption will be higher than net supply. So there's actually simple English, demand is greater than demand will um, outstrip new supply. Okay, there's another question. Technologically, is there anything that differentiate one data center to another? Um, the short answer to that question is no. So other ways that data centers differentiate themselves is by having a track record. That's the number one thing that any tenant wants to see: a track record of operating a data center, a track record of operating data center. But the other thing that can differentiate a data center is whether they are carrier neutral as well, so that um, the tenant can choose their own carriers. Okay, so I think we've come to the end of today's webinar since that was the last question. Um, Thank you for attending the webinar, and see you all again next week.